Good afternoon, everybody, and welcome to the COPEC Daily Financial Wellness live streaming webcast. Happy to be here again today, as always. We've got a good program today. We've got Nate Quilter, who's a certified financial planner with retirement strategies. We're going to talk a little bit about some of the life events, specifically how to deal with and manage inheritances. I went ahead and left that disclosure up for a little bit so everybody could take a look at it. And if you want to see a little bit more on the disclosure, just go to the copeceducation.org website. And down at the bottom, there's a disclosure there. And so you can review that a little bit more thoroughly as well, if you'd like. We'll go ahead and get started. And again, like I mentioned, Nate Quilter, thanks for joining us, Nate, as always.
Thank you for having me.
And we're going to talk a little bit about, throughout the year, about different life events and different ways that we're going to be handling those through the planning process, whether it's planning for, usually just in case, but also how to deal with it at the time and how to make sure you don't make mistakes and things like that. Am I kind of painting a good picture there?
Absolutely, yes, yeah. And as you mentioned, planning for is something I always caution. Usually it's not something that's guaranteed, so you don't want to plan too much for it, but absolutely, if it's imminent or if you just got one, obviously planning is very big. A lot of people kind of don't know what to do or jump to a quick reaction, whereas, hey, you don't have to do something the minute you get it. Usually let's take your time, figure out what your best options are, really.
Yeah, and I would imagine during that big of a, again, it kind of comes on the heels of, it most likely was also an emotional period right now. And I know we've had people where they haven't even cashed checks for a year because emotionally they're dealing with a loss. And to make financial decisions during that time is, we have to put a huge caution sign up there and make sure that we don't do anything rash and many times either get sold improper products or whatever it might be that, we find people sometimes regret because they were doing it when they weren't in the best place emotionally, let's say.
Absolutely, yes. It's not good to make big decisions when you're under some sort of emotional distress. Maybe something as little as, hey, let's just get this paperwork to get it into my name. And then from there, let's take our time, not jump into anything quickly. So yeah, it is definitely, think about it, depending on what you get, there could be tax implications. There could be you locking yourself into something if you make a decision quickly. Or, a lot of people say, oh, I'm going to pay off my house. Well, was that the best decision? Very rarely does it make you worse off, but it may not have been the best thing you could have done by let's say, paying off your house or debt or whatever it may be. So it's all just, hey, sit back. Let's hear all the options, see what the consequences of different actions are as far as taxes go, and then make the prudent decision from there.
Yeah, and I'd imagine there's a little bit of you hate to say it's similar, but as far as, let's call it a windfall financially, right? And again, nobody wants to have to deal with that life event but we're talking about the reality that there is typically a large cash influx into your plan. And one of the things that, crosses my mind from time to time is, I don't know the statistics of it, but you always hear about how people win the lottery, they're broke within 3 years. I know doing this for nearly 30 years, I've watched people mismanage inheritance when they could have used it as a subtle increase in their life standard of living over a longer period of time, rather than some of the short-term, obviously paying off the house might not be as bad of a decision compared to maybe buying a Lamborghini or doing some crazy thing, right? But, the idea that almost, I think sometimes people have this, well, it wasn't my money anyway, and so or like I'm playing with, somebody else's money, so that I'm going to go treat myself. There's so many ways that you can, we talk a lot of planning, needs, wants, wishes, right? To move from the needs, now guess what? My retirement is covered for the way I want because of this wonderful, financial influx to my plan.
Absolutely. And as you mentioned, if you have multiple kids, let's say you've got 4 or 5 kids and they all get an equal amount, no matter how good of a parent you are, whatever values you instilled in all your kids, I can almost guarantee you a third to a half of them are probably going to go through it much more quickly than you might have thought. And then maybe the other half to 2/3 are, like you mentioned, it's going to set them up. They're going to, do it properly. And with the Secure Act that happened last year, it changed how retirement accounts, how those are handled when inheritance happens. So, before it was, hey, you can stretch it out over your lifetime, the person who inherits it. Whereas now granted, different accounts have different rules, but if you inherit an IRA from your parent, let's say, you have to take it out within 10 years, depending on when they passed away. So you might have to take it all out within 10 years. So that takes its own planning to make sure that, hey, you have to take it out and pay taxes, but you don't necessarily need to spend it. What are you going to do with it from there? So there are different strategies you can, enact to make sure you're still doing the best thing, even though you technically had to take it out of the account that it was sitting in a relatively short period of time compared to the old rules. Right.
Now, it's interesting, going back real quick, I want to make one more comment. Two, real quick, for everybody that's on the program, if you want to participate, please go ahead and send your comments, questions, thoughts through. We'll put it into the discussion here. One of the things that I also think about is habits, right? Not only spending through too quickly, but, I think of things like, let's say somebody has a lot of debt, and we've talked about debt. We just had a program with Rick yesterday about credit and things like that. And, let's say you have an inheritance and you're able to pay off some debt that has high interest. Maybe it's an equity line, maybe it's a loan against 401k and all those things. And a lot of times we find that after, and I really am a big fan of the human behavior side of finance, right? And making sure that we cure the habits versus the symptoms, right? Hey, it's wonderful that we have this money, we can pay off some debt, but if you don't work on the budgeting and management and all the things that it takes, you're going to be right back where you were. And we see that too often as well.
Yes, yeah, it's very similar to kind of getting it and spending it all. It all comes down to discipline to an extent, and it takes your own discipline to save and to build up a net worth and accounts, and you have to have that budget to get there. Well, if you were in debt, you don't have that discipline yet. So whether it's spending through the account or using it to do something good, but then just putting yourself right back into that place, that's actually more important than anything, I would say, are the habits that you build. And you can use it as an opportunity to learn and make yourself better in the long run, or because you didn't already have the habits to build it yourself. A lot of times it's gone quickly and you're in the same spot that you were in the first place, even though you got that windfall, as an example.
So when it comes to planning, sometimes I think of things like, do you want to include Social Security? Because you get a lot of people that kind of wonder, it's like, hey, can I count on it? Can I not? Do I put it on my plan? And, we come across this quite a bit with a number of our clients where it's, hey, I expect a certain level of inheritance. And how do you deal with that on a planning side? Because whether it's Medicaid spend down, whether it's just, there's a number of reasons why it doesn't happen the way you think, you know?
Absolutely. And yeah, so I usually prefer to use it as a, hey, if this happens, great. But let's not count on it when you're making your projections long-term. As you mentioned, a lot of things can change over time. It could be, and one thing I always like to ask is, have you had the conversation with your parents about it? So a lot of times you'll have, people who think that they're going to get a large sum from a family member, let's say, just because they may have expectations of where that person stands financially, and they may be overestimating what that person, that person has that they might be getting. So, you may look, hey, I think grandpa's rich, but what if he's not? What if there are things going on behind the scenes that you don't know? So that's different from you just making an assumption as opposed to them having the conversation with you. Hey, I have this separate account set aside for you, and when I pass away, you're going to get X amount. So those are two big differences between the two. But then the other aspect of it is, as well, is yes, a lot of things can change in that time. So maybe it's mom or dad or grandpa, whatever, maybe had planned and has a pretty decent, sizable net worth. But what if a long-term care situation happens and something, and they just spend through, especially if it's a married couple and one of them is still living at home while the other one has to go to a long-term care facility. So they've got all these extra costs, and that money can disappear pretty quickly. You can go through money pretty quickly in situations like that. So maybe they have a type of insurance that will come in if that situation happened, or maybe it is spending down to Medicaid. And it's making the moves to protect it from Medicaid, and then maybe at that point, after that 5 years is up, they won't be, spending anything down. But the number one thing is, before you plan on it for your own circumstances and making sure your circumstances are going to be okay long term, make sure that you've had that conversation and there is an understanding and you understand the variables. So you don't want to be disappointed, I guess would be the word to use, that if something happens to somebody, like you said, you're already dealing with the emotional aspect of it, but then you don't want to be upset about the financial aspect as well. So you don't want to have expectations that maybe don't come true. And the other aspect is, even if they have it, it doesn't necessarily mean they're going to split it, equally amongst, there could be 3 kids, but maybe they helped you out more along the way. And so when they pass away, they're leaving more to the others, or whatever it may be, or they're just mad at you about something and wrote you out of their will. So which I don't like to count on it unless there's been a conversation and
yeah,
been told.
And which, by the way, like I said, between you and me and Jerry and Jen and we have seen this happen way more than people know, where there is some major surprises. Again, we can't say enough. This is not to put money ahead of the relationship and those things. This is the real nitty gritty, that the fact that money is part of the result of somebody passing. But it is never surprising to me, the situations we come across. And I would say 60, 70% of the time they didn't know. And it might be because, I remember one where there was one of the siblings who was kept out of the will, and the other one, and I say kept out of the will generically because it could be beneficiaries, it could be trust, anything like that. And then all of a sudden now the other person got more than what they expected, and therefore financially it was more, but now they have a huge problem between their siblings, and do you disclaim, do you not? What was the wishes of, the parents and things like that? And I know Jerry does a lot of discussions on organizing docs and managing when you care for aging parents and helping, even like writing your own obituary. So if you are a child of a loved one, or you are the older adult, have those conversations so there are no surprises. Make sure it's clear coming out in the front. It doesn't need to be like those movies where the reading of the will and who's left out and, those things. One of the other things that I thought is interesting, Nate, is we have a general rule that if somebody is showing signs of either dementia, or if they're older than 70 years old, we highly recommend that when we do planning and dealing with finances, we recommend that they have somebody there with them. And it's not, there's a lot of concern about the abuse of sales to seniors and things like that. But it's more about just on the drive home, hey, what did they mean by this? Or how did this? And and all of a sudden now you have more ears and more eyes and the listening of what's happening. And so the reason why I bring that up is not only is it the care for seniors or anybody, but especially seniors. When somebody's going through this emotional transition, and if you're not very astute with finances, you've got multiple things going against you. And I don't know how many times we actually help clients get out of things they should have never done.
Absolutely.
Because people do prey on that. Kind of like when they say, when you win the lottery, all of a sudden you get calls all over the place. People actually look at obituaries and chase these things down. It's crazy. But so would you agree that not only having somebody there with you as not just emotional support, but also whether it's a spouse or the siblings or whatever it might be, but helping you remember or discuss and what do I want to do? What makes sense? And then let's walk through a little bit. So let's say somebody does have, an inheritance situation. What are some things they need to consider right away?
Absolutely. A second set of eyes and ears is very good. Almost like, when you go to the doctor, when it's, it's some of the terms, we try to simplify things for people and explain it in as plain English as you can make it. But, there are still complexities in what we do and in the discussions we have to an extent. So number one is, do they understand it? But you had mentioned dementia. So even in a non-dementia case, it's, hey, do you understand it? You really follow what we're talking about? And are you going to, could you repeat this to somebody in the next day, and make them understand it? A lot of times that's not the case, but in a dementia case particularly, it's, a lot can go wrong. It takes a little extra hand holding because it may not be just, hey, I don't understand, or somebody's taking advantage of you, but it may be hey, I called and requested money from my advisor and I forgot that I did, so I do it the next day. And it's a lot of, or I forgot that I paid this bill, so I called to ask for more money that and then take the tax hit of taking it out of retirement. So a lot can go wrong. So a lot of times it's, you need somebody trustworthy there to help you, a kid, a power of attorney, and an attorney, whatever the case may be, to kind of handhold and make sure that everything's.
And let me put out one point of clarification. If somebody has dementia, they need, right?
Absolutely.
We're throwing that word around a little bit as if, if you have dementia and you can't remember your name, no. That's a level where if you have dementia, you need a certain level of power of attorney, elder care, all of those things. I think we're using the word loosely in the sense that as we get older, we forget stuff. Maybe it's potentially dementia that hasn't been recognized yet, right? And you start to see signs because we keep our eyes out for signs all the time. I know that's a big deal, and that's why we want family members involved as much as possible. But let's go ahead and go towards, so somebody passes away, and quite honestly, it might be good to do this sometime with having Russ involved as well with some of the legal, But as far as like some of the things that you think of, not just planning, but also that transactional, like, some of the rules like step up in basis and, how to deal with cash flow issues and stuff like that.
Yeah, definitely. If you don't understand, you need to learn or talk to people who understand. They're all different types of accounts and things you can get, and they're all handled a little bit differently. So if it's a taxable brokerage account that's already been taxed and there's a big gain in it, there's typically what's called a step up in basis. And that means, if you bought stock ABC for $10 and it grew to $30 and you pass away with it, whoever inherits it gets a basis of $30. So if it's worth, or whatever the date of death is, the valuation. So there's no gain anymore that they may have to pay taxes on. So they could potentially, in that type of account, liquidate everything without having to pay any tax almost at all. There are life insurance policies that are similar, maybe no taxable gain on that, but there are other types of accounts, such as retirement accounts that have never been taxed, that every dollar you take out, you're going to pay tax on. So make sure the movement is done correctly. So, if it's an IRA and you move it into a taxable brokerage in your own name, you're paying tax on every dollar of that year, as opposed to being able to stretch it out over, let's say, 10 years or, And so there are different strategies also as well, depending on your situation. If it's a retirement account that you have to take out over a 10-year time frame, well, where are you at in your life? If you're 2 years from retirement, you may want to just wait and not take anything out the first 2 years and take it all out once you retire. If you anticipate higher income, 6, 8, 10 years down the road, maybe you want to take it out a little bit sooner. So there are factors of what type of account you're getting, what the tax situation of it is, how long you can keep it where it is. Sometimes you need to make moves quickly or in a certain time frame. And those rules are changing. Just last year, that Secure Act changed how inherited IRAs are handled. So, and it depends on your relationship. If you're a spouse, you can handle the account differently than a child or a grandchild can. So the main thing is gather information before you make any moves or transfers or anything, and understand how the taxes are going to be affected, what type of account it is, and what your ultimate goal is with it. So if it's going to be used for a down payment on a house in 12 months, you might handle this account differently than this account based on that's what your goal is with the funds. So a lot to take in, but again, it's usually an emotional time. So it's usually best to talk to somebody who understands, who's been through it, or if you have a sibling who's going through it with you, or with somebody else. Make sure you talk it over, talk with an advisor potentially. Make sure you understand what the impact of each scenario is and different things you might do with it and how each account works.
Yeah, and as a last note that we can finish up on, and real quick for those that are in attendance, again, feel free to send any questions, concerns you might have, and we'll talk about those. But if you are in a situation where the person who is passing away, be careful the years, months, days going up to that point. You mentioned earlier about capital gains. Not only is that something that happens, there's a certain rule, there's tax benefits, step up basis, but if somebody gives that away in expectation of death, you are losing the benefit of that step up basis. So you can be on your deathbed and said, hey, Nate, I'm going to give you this $50,000 because I want to get it done while I can, right? Well, by doing that, you made it so that the beneficiary has to pay tax on all of those gains. Whereas if it were 6 months later, 3 months later, a day later, then all of a sudden that 50,000 would be hypothetically tax-free, depending on what growth afterwards. So, whether it's, making sure documents are in line, making sure communication is in line, making sure transfer of assets are done properly, the equitability, being equitable between, how a will reads versus beneficiaries versus a trust, because you could have those all three different things, and balances are all over the place. So, I think just have that in mind if you're dealing with that situation, that, it's tough to sit there and go, hey, it's the end of somebody's life. Let's do some planning. I mean, it's really hard to do that. And we understand that. And that's the reason why having those conversations as soon as possible while people are healthy, because it's, in my family, not every Christmas, but pretty much every couple years, we have a discussion when everybody's together at Christmas, and my parents will sit there and say, hey, just want to make sure everybody knows that we have this, here's where it's stored, we have our power of attorney is J or this, or, whatever it is. And, it's kind of put out there when it's not, right around the corner, imminent. And so when it is imminent, people know what to do. People understand what the plan was or what the ideas were, and they understand some of that. So the education, communication, all of that in place. Absolutely.
Communication is key. A lot of times talking about money is taboo for some people. I mean, that's what we do for a living. So, it's not taboo for us, but, it's one of those things. The more communication there is, the smoother things can go. And a lot of times, not necessarily how smoothly it goes, but maybe the results are better by having those conversations. So definitely.
And sometimes having a third party in there helps as well.
Absolutely, yeah. Sometimes it's just a vote. Third vote,
yeah. Well, hey, thanks a lot. As always, Nate, we'll see you next Thursday. Do you have any other programs coming up? Anything else?
Nothing before next Thursday that I know of, no.
Okay, great. Well, hey, thank you so much for joining us, and we'll see you next week. Everybody have a great afternoon, and we'll talk to you tomorrow. Take care, everyone.
Thank you for your time. Thank you for having me.
All right, bye-bye.
Bye.